Hello, everybody. Brian here from quantlabs.com. In this video, I want to talk about predicting how I think we may be already there. I don't know. Predicting how a lot of these algo trading firms and the like will uh, move ahead, move forward in terms of what they need, in terms of technologists, meaning coders, along with even as an individual. So what I'm showing you right now is in my WSL Ubuntu 24, and this is my last module in my latest course that focuses on futures and options, very uh, HFT-like strategies, both C++ and JavaScript. So I'm not going to show you the code itself, but I think it's important to appreciate. Let me just pull this up. So now I'm in a Linux shell, okay? I've set it up for my system. I'm using, as I said, WSL on Windows. So let me just pull up the general text file I want. I've always used uh, Sublime as my editor. I'm not right now using any form of any form of IDE or whatnot. I just do it right on the terminal and the basic shell for the compiling and linking. Okay, so this is, I've got 25 plus videos, very deep, very diverse, and different types of code in C++, a little bit in Python, and a lot of the more advanced charting, visualization, and JavaScript, because just JavaScript's just way better than Python and its best day could ever be. So this is the last stage. This is the end game. What a lot of HFT firms focuses on. So I want to show you the different scenarios. So there's four examples coming out of this last module. So this one's a C++ program that evaluates different puts options based on the provided scenario. So as a coder, as a quant team, as a trading firm, I don't know. They could have many different coding options that they could use, different strategies based upon the market data they see, and how are they going to play it out in order to trade what they want to trade. So it's not going to be, I believe, down the road where it's going to be some static algo or some static uh, code base. It's going to be a lot of it will be code generated. I think that's where we're going with this. And the need for standby coders that know this stuff inside out. I don't know. I can't say if their days are numbered, but definitely there'll be fewer needed for this type of stuff. So again, we have different market scenarios for different types of put options. So this program will calculate the floor price for two put options. So let me show you what it does. So in here, we are looking at a little bin file called floor prices. So this is what we're presented with. Okay, so we have put option one, strike price at 625, premium at 25 cents, floor price at 624. Put option number two, $600, premium at 7 cents, floor price at 599. Okay, so that's a standard market scenario that any firm will have based upon market data they see. Which one do they go with? Option one, and then you have to analyze this. Okay, so all of this will be needing to be built into this kind of program. Option one offers a higher floor price but costs more. So, just as an example from this, what are some of the key considerations for selecting this optimal strike price? Okay, so higher strike price provides quarter price protection but incurs a higher premium, and the lower strike price is cheaper but offers less protection. So these are going to be now the standard questions that a firm in your advanced knowledge on and the recruiting process of these firms, they're going to present you with this type of scenario. Which one would you go with and code it up? So this kind of course will cover that for you, but there's a lot of theory that takes you up to this. So in order to do this, you can't do this statically. You can't chat GPT your way out of this. This is just a standard interview, or real scenario that you'll need to know. So which option that's presented to you do you go with and why? Okay. So you're not only going to have to know how to program it and code it up, you're going to have to explain why in what you see in the markets using all the different types of data out there. Just one example. Okay, so let's go to the next script. Again, C++ presented. Okay, so this is now for just a basic farmer. So this program simulates a scenario where there's a price decline that protects against downside risk and price increase that allows the farmer to benefit from a market gain. So again, this is a standard scenario that all trading firms at all situations, every day in, day out, will be faced with this. So what does this program do? It calculates the outcome based on the provided assumptions. Let's run it. So now we have different strike scenarios. I think I might have gotten these reversed. Okay, so let's just go with this. So this is a lot more detail. So scenario one, we have a high strike price option, more protection. New futures price at 620, new cash price at 580, intrinsic value. And you could see now if you're smart and you know you want to get into these positions or even trade potentially, you got to know something called intrinsic value. You also got to know what notional value is as well. And this just is a put 450 where it expires worthless, the net return, and this is all projected. Net returns at 584.75. What's the key takeaway on this particular strategy scenario? Key takeaway, the high strike price provides a strong floor price, limiting losses during a price decline. Scenario number two, this will be a standard question for you in the world of interviews. If you cannot understand this, don't go into these firms because this is going to be what gets you into the door, not just into the door, but into the job so you can get your paychecks back. Uh, so in the long run, again, these are different scenarios that you need to explain. So they'll test you on this. So now scenario two, low strike price option, more upside potential. New future price at 619, new cash price at 579.20. Doesn't matter what it is. Doesn't matter what kind of option it is. Doesn't matter what the underlying is. It don't matter what asset this is. It's just the price and the analysis on what to go with based upon this data. So then you get intrinsic value of a put of 0, expiring worthless, and a net return of 579. Which one do you go with? Price increase scenario. So now we're looking at the future price, where the future price goes up to 620.50 with a new cash price of 580. Intrinsic value put, again, to understand that, and again, you got to go through the theoretical, where you have $0 expires worthless. So your net return is at 580. So here's your key takeaway on this. So the lower premium allows for more profit if price rises, but offers significantly less protection if the prices falls. Does this sound familiar on how these trading firms trade? You need to have the proper insights, how all the mechanics work, how the coding works as well. So now let's compare the different strategies. So here we have the different strategies of balancing the risk and the reward. Forget what the retail does. We are using institutional level options and futures trading. So here's our scenario. The high strike price at 625 or low price of a strike price of 600. Premium at 25 cents or the premium at 7 cents. We have a floor price of 584.45 and 579.13. Then we have a net return forecasted of 584.45, 579.13 on the other. Net return on the increase of 579 or 580.13. So which one do you go with? This is the sort of stuff you will be tested on. You will be put in front of a whiteboard, and they're going to ask you stuff like this. So what are the key points from this? The higher strike price provides better protection but costs more, while the lower strike price allows for greater upside potential. Okay, so how do we choose the right strategy? This is all tailored for your needs based around these different data criteria, along with a different expectation on future price. Price expectation, bullish, expected price increase favors lower strike price. If it's bearish, expecting price decrease, favoring higher strike price for stronger protection. So the neutral versus uncertain is a decision depends upon the risk tolerance. That is where you start needing to learn about the risk on that you put on your overall portfolio or the different portion within your portfolio to measure the risk on all your open positions as well. And this changes every couple of seconds. This is the typical scenario of what these high frequency trading firms go through. So now we have risk tolerance, risk averse farmers may prioritize higher strike price even at a higher premium. Okay, maybe. Market outlook volatility. Higher volatility generally means makes options more expensive. So these are the considerations you need to understand before you go out and code it. This is what your quant modelers, quant researchers are looking at as well. Okay, so that's just an example of a very deep, complex scenario on a simple option price and a forward price. Which one do you go with, and how do you lay it all out? Just as an example to show you the complexity on the trading side, let alone all the technical mumbo jumbo of C++ and Linux low level. This is what they pay you for. Simple as that. So let's start looking at what the JavaScript gives us. Um, so let me go back to our file. So now, um, oh, we have a third scenario. C++, a program that evaluates scenarios of put options, one with a higher strike price offering more protection, and another with a low strike price for greater upside potential. Program calculates the outcome of each scenario based on the provided example. That's what I just showed you. Let's see what the scenario is. Another example. Okay, so this might be the prior. So yeah, so let's just go through this. So this is another example of what would be expected for you to understand either from the quant side, the coding side, or whatever side you want to call it. Scenario one, price decline. This is all forecasted. New future price 619, new cash price at 579, intrinsic value at 550, net return at 584. Put option provides a price forward resulting in a net return of 584. Scenario two, price increase, new future price 620, new cash price of 580, intrinsic value put 450 expires worthless. Net return of 584.45. What's the key takeaway? Put option expires worthless, but the farmer benefits from the higher cash price. Explain that to whoever you're talking to. You got to know your stuff. That's all I'm saying. Next, let's start playing with the JavaScript as well. So in this example of one of the JavaScript I was showing, basically a chart, program uses D3.js for visualizing hedging strategies. Again, hedging strategies. Again, you can arbitrage, you can hedge, you can do a whole combination of them. Particularly focused on the long cash position and put option. This program includes an introduction payoff diagram and the impact of different strike prices. So this is what quants are looking at. This is what the live traders are looking at these firms. So let's start playing with this. So our first one we can look at is, I think it's just one. Actually, we got a bunch here. So let's load up this one as an example. Okay, so this is just a standard HTML file. I'm not going to show you the code, but I'll gladly show you the chart. Okay, let's do it. So again, this is all run within Linux. Let's see if my Firefox will load. Come on. There we go. Okay, so here's the chart right here. Okay, so long cash position, put option diagram. People live and breathe off of these, but a lot of traders, retail traders, will not even know about this stuff, will not understand it, and whatnot. But this will just basically tell you your break even, your gold area that you want to trade within, along with the put option as well. Okay. So this is a typical what your premium needs to be set at, what your strike price needs to be set at, and you can measure the different zones that you could trade in, and you can develop a piece of code, a C++ program or whatever, however you're, if it's a system that you could develop to only trade within those zones. And you right within here, you have your your different areas for both your entry and exit. You don't need to take stop losses here. You're letting these charts, these limitations, these restrictions based upon this data to enable you to know your entry and exits right here. along with all the different layered positions as well. Okay, let's open up the next one. All righty. So that worked pretty good. So that's our first example. And if this intimidates you, it's not to scare you off, but this is a typical sort of environment you'll be put into as well. I mean, it's not going to be, the principles will be similar to this. Let's look at our next one, the long cash position put option payoff diagram. There's a lot of payoff diagrams here. So again, similar pattern here, premium set, strike price, and you could develop a whole pile of strategies from this on the risk when you have here um, your on the X here, profit loss. So obviously you want to be here. This is your floor. And if you could code things like up like this and be able to show your risk and your lower floor price and how you synthetically develop, let's say, an option or maybe a variety of different option trades via hedging, via arbitrage opportunity. Um, this exists. So I'm going to load up the last one, the very last one, which is here, visualizing hedging strategies, understanding hedging gradually. Okay, so this one will measure different strategies, and you can see it graphically. So I think this is the future of coding as well. So here we got a bit of an explanation, visualizing hedging strategies, understanding hedging graphically. So hedging is a form of risk management strategy to mitigate potential losses from adverse price movement. A put options gives the buyer the right but not the obligation to sell an asset to uh, specific strike price or on before a certain date. So it's all about these floor prices, and with the options overlaying it, you virtually have um, no upside limitation because with an option, what you're doing is you're setting your floor price because that's the premium you pay at. You pay that out um, out of pocket, and that's how you open and create your option or a variety of options, and then you measure when they get in based upon this type of similar data. So what are we looking at here? Presentation to use graphical analysis to visualize the payoff, thus it's called a payoff diagram, of hedging soybean prices with put options and understand. Now, understand here, it's not just one or two options. It could be a variety of them um, layered in with futures options or futures as well, and understand the impact of different strike prices on expected return. Okay, so this is more of a simplistic way of looking at it, but this is how a lot of the traders will look at that stuff. Okay, so my point here is this is how it's typically done. Okay, especially a lot of HFTs firms will mostly be trading in currencies, futures and options, maybe other commodities as well, indices, individual stocks as well. But it's usually with a notional value they look at as well, not just the spot price, because the notional gives you a wide variety of different data and different exposure that they can see that a lot of the retail, call it dumb money, will not see. But that's why it's important to understand this. This is why I'm stressing people need to really get into this kind of course from an institutional point of view to get in a career. The trading is always comes first. There's the mathematical, there's the quant mathematical in this as part of this, on top of the coding to come up with the strategies and scenarios I just presented you. This is how it's done. This is how you get the job. End of story. Okay, you could be the best technical all-star knowing all your memory handling and all that. But if you really want the high paying jobs, this is the sort of stuff you got to know. Over now. Have a good day.